Welcome back to Personal Finance Simplified. I'm your host, Ishika Chandra, and today is Wednesday, August 12th. Today's episode is all about how to start investing in your 20s. Now, I know that investing can sound intimidating. You might hear terms like stocks, ETFs, mutual funds, Roth IRAs, or the stock market and think, I have no idea what any of that means. The good news is that by the end of this episode, you'll understand the basics of investing, why starting early matters, and how you can begin investing, even if you only have a small amount of money. But before we dive into where to invest your money, let's first answer a simple question. What exactly is investing? Investing is using your money to buy assets that have the potential to increase in value over time or generate income. Instead of letting your money sit in a checking account, earning little or no interest, you invest it with the goal of growing your wealth over the long term. Think of it this way. Imagine you have $100. There are so many options for what you can do with those $100. You can put it in a checkings account and later use it to buy a new pair of shoes. Or you can invest that $100 in a stock or an index fund. Both of these are forms of investments, and I'll go into detail about them later on. If your investment grows by 10%, your $100 becomes $110. Now, that might not seem like a lot, but here's where investing starts to become really powerful. Over time, your money has the opportunity to continue growing, and eventually, the money you've earned can begin earning money too. This is called compound growth, and it's one of the biggest reasons experts encourage people to start investing as early as possible. For example, if your investment continues to grow over many years, that original $100 could eventually become $200, $500, or even much more, depending on how long it's invested and how the investment performs. Of course, investments don't grow by the same amount every year, and there will be years when the market goes down. But historically, over long periods of time, the stock market has generally trended upwards. Instead of your money sitting in a checkings account earning little or no interest, investing gives your money the opportunity to work for you. It's like hiring your dollars to earn even more dollars, even while you're sleeping, studying, or at work. Growing your wealth over time is one of the biggest reasons people choose to invest, but it's certainly not the only reason. Another major reason people invest is to beat inflation. Inflation is the gradual increase in the prices of goods and services over time. Think about it. Something that cost $2 10 years ago might cost $3 or $4 today. As prices increase, the purchasing power of your money decreases. In other words, the same $100 won't buy as much in the future as it does today. That's why simply keeping all of your money in a checkings account isn't always the best long-term strategy. While it's important to have money set aside in a savings account for emergencies and short-term goals, investing gives your money the opportunity to grow faster than inflation over the long run. People also invest to achieve important financial goals throughout their lives. Maybe you want to save for a down payment on your first home, start your own business, retire comfortably, or even achieve financial independence so that work becomes a choice instead of a necessity. Investing can help you work towards these goals by allowing your money to grow over many years. Finally, people invest to prepare for retirement. Most people don't want to work for their entire lives. Eventually, they'll want to stop working and still have enough money to pay for housing, food, healthcare, travel, and other expenses. By investing consistently throughout your 20s, 30s, and 40s, you can build a retirement fund that supports you later in life. So while growing your money is one of the biggest benefits of investing, it's really about much more than that. Investing is a tool that can help you keep up with inflation, reach your financial goals, and prepare for retirement. Now, everything we've talked about so far raises an important question. If investing is so powerful, when should you start? The answer is as soon as you reasonably can. One of the biggest advantages you have in your 20s isn't that you have more money than everyone else, it's that you have time. In fact, time is one of the most valuable assets an investor can have. Why? Because of something called compound growth. Remember earlier when I mentioned that your investment earnings can begin earning money themselves? Well, the longer your money stays invested, the more opportunities it has to compound. Instead of just earning returns on the money you originally invested, you're also earning returns on the gains you've already made. Let me give you an example. Imagine person A starts investing $200 every month at age 22 and continues until they're 65. Now imagine person B waits just 10 years and starts investing the exact same $200 every month at age 32, continuing until they're about 65. Even though both people invest the same amount every month, person A will likely end up with significantly more money simply because they gave their investments an extra 10 years to grow. Those extra years allow compound growth to work its magic. You'll often hear people say that time in the market is more important than timing the market. Many beginners think they need to wait until they have thousands of dollars to invest or until the stock market is perfect. The reality is that waiting can be far more expensive than starting with a small amount today. Even investing $25, $50, or $100 a month consistently can make a meaningful difference over several decades. Think of investing like planting a tree. The best time to plant a tree was years ago. The second best time is today. The earlier you plant it, the more time it has to grow. The same is true with investing. Every year you wait is one less year for your money to compound. Does that mean if you're in your 30s, 40s, or even 50s, you've missed your chance? Absolutely not. It's never too late to start investing. However, if you're listening to this podcast in your late teens or 20s, you have something incredibly valuable that you can never get back: time. So don't let the idea of needing a lot of money stop you from getting started. The most important step isn't investing a huge amount. It's simply getting started and being consistent. Now that we know what investing is and why starting early is so important, the next question is, what exactly are you investing in? If you've ever heard people say things like, I bought Apple stock, or I invested in an S&P 500 ETF, you might be wondering what those terms actually mean. Let's start with one of the most common investments: stock. A stock is simply a small piece of ownership in a company. When you buy a share of a company's stock, you're becoming a partial owner of that business. That means if the company grows and becomes more valuable over time, the value of your investment may also increase. Some companies also pay shareholders a portion of their profits through payments called dividends. For example, imagine a company is divided into 1 million shares. If you buy one share, you own a tiny fraction of that company. It doesn't mean you get to walk into the CEO's office and start making decisions, but you do own a very small piece of the business. The value of a stock changes every day based on supply and demand and investors' expectations about the company's future. And if investors believe the company will continue growing and earning more money, the stock price may increase. If the company struggles or investors lose confidence, the stock price may decrease. Now, while buying individual stocks can be exciting, it also comes with more risk. Think about it this way. Imagine you invest all of your money into just one company. If that company performs really well, you could earn a great return. But if the company has financial problems or goes out of business, you could lose a significant portion or even all of your investments. That's where ETFs, or exchange traded funds, come in. Instead of buying stocks in just one company, an ETF is like buying a basket filled with many different investments all at once. Imagine walking into a grocery store. Buying one apple is like buying one individual stock. Buying a fruit basket filled with apples, oranges, bananas, grapes, and strawberries is like buying an ETF. If one piece of fruit isn't great, you still have all the others. Similarly, if one company inside an ETF performs poorly, the other companies can help offset those losses. For example, an ETF that tracks the S&P 500 owns shares in about 500 of the largest publicly traded companies in the United States. Instead of trying to guess which single company will perform the best, you're investing in hundreds of companies across many different industries. This is called diversification, and is one of the most important concepts in investing. Diversification simply means spreading your money across many investments instead of putting all your money into one place. It's the investing version of the saying, don't put all your eggs in one basket. If you drop one basket holding all your eggs, you lose everything. But if your eggs are spread across many baskets, one accident won't ruin them all. The same idea applies to investing. For most beginners, especially those investing for retirement or long-term goals, ETFs are often a great place to start because they provide instant diversification and are generally lower risk than owning just one stock. And they also don't require you to constantly research individual companies. That doesn't mean that individual stocks are bad. Many experienced investors own individual stocks because they believe certain companies will perform exceptionally well over time. However, if you're just getting started, many financial experts recommend building the foundation of your portfolio with diversified investments like ETFs before investing in individual stocks. So to summarize, a stock is an ownership in one company. An ETF is a collection of many different investments bundled together into a single investment. Neither is automatically better than the other. They simply serve different purposes. But for many young investors who are just starting off, ETFs can be an excellent way to build a diversified portfolio while keeping things simple. Now that we've talked about what you can invest in, like stocks and ETFs, the next question is, where do you actually buy these investments? The answer is through an investment account. Think of an investment account like a container. The account itself isn't the investment, it's simply the place where you keep your investments. It's kind of like a wallet. Your wallet isn't money, it simply holds your cash and cards. Similarly, an investment account holds your stocks, ETFs, index funds, mutual funds, and other investments. One of the best investment accounts available for many young people is called a Roth IRA. IRA stands for Individual Retirement Account. A Roth IRA is a retirement account that allows your investment to grow tax-free. And if you follow the rules, you can withdraw that money in retirement without paying federal income tax on the earnings. That's one of the biggest advantages of a Roth IRA. Normally, when you make money from investments, you may owe taxes on those gains. But with the Roth IRA, if you meet the requirements, your investments can grow for decades, and when you retire, you can take out both your original contributions and the investment earnings tax-free. So how does a Roth IRA work? Unlike a traditional 401k, where contributions are often made before taxes, a Roth IRA is funded with after-tax dollars. That simply means you've already paid income tax on the money before putting it into the account. The benefit is that you don't pay taxes again when you withdraw qualified distributions in retirement. For many people in their late teens and 20s, this can be especially attractive because they're often in a lower tax bracket than they may be later in their careers. In other words, you pay taxes now while your income and tax rate may be relatively low, and then your qualified withdrawals in retirement can be tax-free. Inside your Roth IRA, you can invest in many different things. For example, you could buy individual stocks, ETFs, index funds, mutual funds, and bonds. Many long-term investors choose diversified index funds inside the Roth IRA because they provide broad exposure to the market with relatively low fees. Another great feature of a Roth IRA is flexibility. Because you contribute money that you've already paid taxes on, you can generally withdraw your original contributions at any time without paying taxes or penalties. However, the investment earnings usually need to stay in the account until you meet the rules for qualified withdrawals, or you could owe taxes and penalties. Because retirement account rules can be complex, it's a good idea to understand those rules before taking money out early. One thing to keep in mind is that there are annual contribution limits, meaning you can only contribute up to a certain amount each year if you're eligible. There are also income limits that determine who can contribute directly to a Roth IRA, so it's worth checking the current IRS rules each year. So who should consider opening a Roth IRA? If you have earned income from a job and you're investing for retirement, a Roth IRA can be an excellent option because it combines one of the most powerful investing tools, compound growth, with one of the most powerful tax advantages available. The earlier you begin contributing, the more years your investments have to grow. Imagine contributing consistently throughout your 20s, 30s, and 40s. By the time you reach retirement, your money may have had decades to compound, and qualified withdrawals can be completely tax-free. That's why many financial experts encourage young adults to open a Roth IRA as early as they're able. To summarize, a Roth IRA is not an investment. It's an investment account. Inside the account, you choose investments like ETFs, index funds, or stocks. The account provides the tax advantages, while the investments inside the account provide the opportunity for long-term growth. Now we've talked about one of the best retirement accounts available, the Roth IRA. But what if you want to invest in money that you might need before retirement? That's where a brokerage account comes in. A brokerage account is probably the simplest type of investment account. Just like a Roth IRA, a brokerage account allows you to buy and sell investments like stocks, ETFs, index funds, mutual funds, and bonds. The biggest difference is that a brokerage account is not a retirement account. Think of it this way. Imagine you have two different boxes. One box is labeled retirement. That's your Roth IRA. It comes with valuable tax advantages, but there are rules about contributions and when you can withdraw your investment earnings. The second box is labeled general investing. That's your brokerage account. It doesn't have those same tax advantages, but it also gives you more flexibility. With a brokerage account, you can generally deposit money wherever you want, whenever you want, invest it however you choose, and sell your investments whenever you need to. There are no annual contribution limits like there are with the Roth IRA, although you'll generally owe taxes on investment gains, dividends, and other taxable income according to current tax rules. Because of that flexibility, brokerage accounts are often used for goals that are still several years away but happen before retirement. For example, you might invest in a brokerage account to save for a down payment on a house, starting a business, financial independence, building wealth beyond your retirement accounts, and any other long-term financial goal. It's important to remember that investing is generally best for money you won't need in the near future. Since the value of investments can go up and down, money you'll need in the next few years is often better kept in a savings account or another low-risk option. So how do you actually use a brokerage account? Let's say you open one and deposit $500. That money doesn't automatically get invested. It's simply sitting as cash in the account. You then choose what you'd like to invest in. For example, you might decide to purchase shares of an S&P 500 index ETF, a total stock market index fund, individual company stocks, or a combination of different investments. After you buy those investments, they'll remain in your brokerage account where they can grow or decline in value over time depending on how the market performs. One advantage of a brokerage account is flexibility. Unlike retirement accounts, you don't have to wait until retirement to access your money. If you decide to sell your investments, you can generally withdraw the proceeds whenever you need them, although selling investments at a profit may have tax consequences. So when should you choose a brokerage account instead of a Roth IRA? If you're investing specifically for retirement and you're eligible, many financial experts recommend contributing to a Roth IRA first because of its tax advantages. However, if you've already contributed as much as you're allowed to in a Roth IRA or you're investing for goals before retirement, a brokerage account can be an excellent next step. To summarize, a brokerage account is a flexible investment account that lets you buy and sell investments without the contribution limits or retirement restrictions of a Roth IRA. A Roth IRA is designed specifically for retirement and offers significant tax advantages if you follow the rules. Both accounts can hold the exact same investments. The biggest difference is how they're taxed and what they're designed to help you achieve. The key takeaway is this: the account is simply the container. The investments inside the account are what help your money grow. Now that you know where to invest your money, let's talk about how to invest it. One of the biggest questions new investors ask is, should I wait until the stock market goes down before I invest? The truth is, nobody knows exactly what the stock market is going to do tomorrow, next month, or even next year. Even professional investors and economists can't consistently predict when the market will reach its highest point or its lowest point. That's why many long-term investors use a strategy called dollar cost averaging. Dollar cost averaging simply means investing a fixed amount of money at regular intervals, regardless of whether the market is going up or down. For example, instead of waiting until you have thousands of dollars to invest, you might decide to invest $100 every month. Some months the market will be higher, some months the market will be lower, but you keep investing the same amount consistently. Let's look at a simple example. Imagine you invest $100 every month into the same ETF. Month 1, the price is $20 per share, so your $100 buys 5 shares. In month 2, the market drops, and the price falls to $10 per share. Now your $100 buys 10 shares. In month 3, the market recovers and the price rises to $25 per share. Your $100 now buys 4 shares. Notice what happened. When prices were low, your fixed $100 bought more shares. When prices were high, the same $100 bought fewer shares. Over time, this can lower the average price you may pay per share compared to trying to guess the perfect time to invest. One of the biggest benefits of dollar cost averaging is that it removes emotion from investing. When the market drops, many people panic and stop investing because they're afraid they'll lose money. Ironically, market declines often allow you to buy more shares for the same amount of money. On the other hand, when the market is reaching new highs, many people rush to invest because they don't want to miss out. Dollar cost averaging helps avoid both of these emotional decisions. Instead of trying to predict the market, you stick to your plan and continue investing consistently. That's why you'll often hear the saying, time in the market is more important than timing the market. No one can consistently predict when the perfect time to invest will be, but by investing regularly over many years, you're allowing time and compound growth to work together. Another advantage is that dollar cost averaging makes investing feel more manageable. You don't need thousands of dollars to get started. Maybe you invest $25 a week, $50 every 2 weeks, $100 each month. The amount isn't nearly as important as the habit. As your income grows over time, you can always increase the amount you invest. Now, it's important to understand that dollar cost averaging doesn't guarantee you'll make money or protect you from losses. If the market declines for an extended period of time, the value of your investments can still go down. What dollar cost averaging does is encourage consistency and reduce the temptation to make emotional decisions based on short-term market movements. For many people, one of the easiest ways to use the strategy is to automate it. For example, if you get paid every other Friday, you can set up an automatic investment so that $100 is invested into your chosen ETF or index fund every payday. Once it's automated, you don't have to think about whether today is the right day to invest. You simply continue investing month after month, year after year. To summarize, dollar cost averaging is the strategy of investing a fixed amount of money on a regular schedule, regardless of what the market is doing. It's simple, it's consistent, and it helps you build wealth by focusing on long-term investing instead of trying to predict short-term market movements. And that brings us to the end of today's episode on how to start investing in your 20s. Let's quickly recap what we learned. First, investing is simply using money to buy assets that have the potential to grow in value over time. Unlike keeping all of your money sitting in a checkings account, investing gives your money the opportunity to work for you through growth and compound returns. We also talked about why starting early matters. Your biggest advantage as a young investor isn't necessarily how much money you have. It's the amount of time you have. The earlier you start, the more time your money has to compound and growth. We also discussed different ways to invest, including stocks, which represent ownership in individual companies, ETFs, which allow you to invest in a collection of different assets, index funds, which are designed to follow a specific market index and provide diversification, Roth IRAs, which are retirement accounts that offer valuable tax advantages, brokerage accounts, which provide flexibility for investing towards goals outside of retirement. Finally, we talked about dollar cost averaging and why consistency is often more important than trying to find the perfect time to invest. The biggest takeaway I want you to remember is this: you do not need to be rich to start investing. A lot of people think that investing is something they can only do after they have a high-paying job, thousands of dollars saved, or a complete understanding of the stock market. But the truth is, investing is a skill that you build over time. You can start small by investing $25 a month or $50 a month, and you will learn as you go. The most important thing is building the habit of investing and allowing time to work in your favor. Remember, personal finance is not about making perfect decisions. It's about making intentional decisions that move you closer to your goals. The money you invest today may not seem like a lot right now, but future you will be grateful that you started. Thank you so much for listening to Personal Finance Simplified. If you enjoyed this episode, make sure to subscribe so you don't miss future episodes where we break down personal finance topics in a simple and beginner-friendly way. I'll see you guys next Wednesday.